Assalamualaikum and good day to Dr. Dayang. Today I'm going to be presenting about corporate restructuring. Okay, first we're going to talk about merger and consolidation. Okay, first of all, merger. A merger refers to the absorption of one firm by another. The acquiring firm retains its name and identity. Second of all is consolidation. A consolidation is the same as a merger except that an entirely new firm is created. In a consolidation, both the acquiring firm and the acquired firm terminate their previous legal existence and become part of the new firm. Okay, next there are two types of acquisition. Acquisition. First of all is acquisition of stock, and second is acquisition of assets. Acquisition of stock is a second way to acquire another firm is to purchase the firm's voting stock in exchange for cash, shares of stock, etc. The following factors are involved in choosing between an acquisition of stock and a merger. Okay, first, in an acquisition of stock, shareholders meeting need to be not to be held and a vote is not required. In an acquisition of stock, the bidding firm can deal directly with the shareholders of a target firm via a tender offer. The target's firm management and board of directors are bypassed. Next is acquisition of assets. One firm can acquire another by buying all of its assets. The selling firm does not necessarily vanish because its share can be retained. A formal vote of the target shareholders is required in an acquisition of assets. An advantage here is that although the acquirer is often left with minority shareholders in an acquisition stock, this does not happen in an acquisition of assets. Okay. The cost of the company's restructuring is because of merger. Suppose firm A acquires firm B in a merger. Further, suppose firm B's shareholders are given one share of a firm A's stock in exchange for two shares of firm B's stock. From a legal standpoint, firm A's shareholders are not directly affected to the merger. However, firm B shares cease to exist. In a consolidation, the shareholders of firm A and firm B exchange their shares for shares of a new firm. For example, General Motors during the year 2008-2009 faced a financial crisis. General Motors, once the largest car manufacturers in the world, faced severe financial difficulties due to declining sales, high labor costs, and an economic recession. By 2008, the company was struggling with the mounting losses and a significant debt load, making it clear that a major restructuring was necessary to avoid bankruptcy. There are several restructuring steps that the company takes, which we get to later. Okay, first is bankruptcy filing. On June 1st, 2009, General Motors filed for Chapter 11 bankruptcy protection. This move, this move allowed GM to recognize its debts and operation under court supervision while continuing to operate. Second is government bailout. The US government provided a bailout package totaling approximately 49.5 billion to support GM through the restructuring process. This financial aid was critical in keeping the company afloat during its reorganization. And third one is asset sales and divestitures. GM sold or discontinued several of its brands and assets as part of the restructuring. For example, it sold the Hummer brand to a Chinese company, discontinued the Pontiac brand, and sold its same unit to a Swedish firm. This streamlining helped GM focus on its core brands such as Chevrolet, Cadillac, Buick, and GMC. And fourth is labor cost reduction. GM negotiated labor agreements with the United Auto Workers Union, resulting in significant cost savings. This included wage reductions, changes to healthcare and pension plans, and a shift towards a more flexible labor structure. And fifth is operational restructuring. GM closed several plants and reduced its workforce to lower operating costs. The company also focused on improving efficiency and productivity across its remaining operation. Sixth one is debt restructuring. GM converted a significant portion of its debt eh, into equity, reducing its overall debt burden. Bondholders received equity in the reorganized company in exchange for their claims, which helped to clean up GM's balance sheet. And the last one is new leadership and strategic focus. GM appointed a new CEO, Fritz Henderson to lead the company through the restructuring process. The company also shifted its strategic focus towards producing more fuel efficient and environmentally friendly vehicles, anticipating future market trends and the regulatory requirements. Okay, the outcome of this is that the restructuring process allowed GM to emerge from bankruptcy in July 2009, just 14 days after filing, as a leaner and more competitive company. By 2010, GM returned to profitability, and in November 2010, it conducted a successful initial public offering, raising $23.1 billion. The government gradually sold off its stake in the company, and by December 2013, GM had fully repaid its bailout funds. As a conclusion, General Motors restructuring during the financial crisis is a prime example of how a combination of government support, strategic divestitures, labor negotiation, and operational changes can enable a struggling company to revert itself and regain stability.